Okay, very good. Excellent. Well, thanks for joining.
Thank you for that introduction. So Kate is the D1 soccer star, although she will not be joining today. She had a conflict that came up, unfortunately, so I'll be taking this one solo today. Just a bit more about myself before I get into this. As Tom said, I get to work with companies along the entire life cycle, sort of from founding. I get to work with startups, sort of that first couple rounds of funding, the putting together the first operating agreement and the governance documents, all the way to the exit, both helping founders sell on their own exit, but also working with our private equity clients to try to help partner with founders in a lot of cases through a sizable rollover and helping with the exit in that way. Yeah, please, thank you. So I got a note that it's hard to see me with the shadow. Apologize for that. So today I was going to be discussing business plans. I hope everybody has the handout. You'll see that it's basically a template that we've set up. And my plan was just to walk through the template, sort of hit the highlights, add a little bit of color where appropriate. A couple things worth mentioning at the outset. Why do you put together a business plan? There's really two reasons to do it. The first is sort of an internal reason for purposes of organizing and planning. It's often said that the first investor in a startup is the founder himself. So it can be useful just to confirm that the business is a good idea. It's something you want to jump in on fully. The second reason, thank you, is for investors. And so that's going to look a little bit different. That's going to be what we're focusing on today, but that's going to be a little bit more formal, a little bit more marketing and feel. It's worth noting right at the outset that the first draft of your business plan should be written in pencil because it's going to change over time. As markets change, as competitors change, as your assumptions that you're making change, your business plan needs to change too. It should be a living document. And you should be looking to review it at least every 6 months or so. So next slide is the table of contents. Really the keys are the executive summary and the financials. That's going to be what most investors focus on. In looking at the table of contents, I want to just quickly mention, don't get bogged down by the form. If there are pieces that don't make sense to your business, they don't need to be included. If there are things that you want to call out to investors or you feel are important, feel free to add them. You don't want to spend too much time on your business plan if it's, to the detriment of building the business. So really you want to make your business plan work for you. So the executive summary is really the most important piece. It's a little bit funny because you have to write it last because it's really sort of a distillation of the balance of the document. It's sort of the highlights of the entire business plan. So the recommendation is definitely do it last, do it concise and hit the high points. But from a high level, what you're doing in the executive summary is describing, this is who we are, and this is why this venture is going to be successful. This is how we're going to generate revenue. The executive summary is meant to convince the investor that they ought to dig in more deeply and read the entire business plan. Rather than sort of go deeply into each of these sections, I'm going to wait until we hit the actual sections in the body of the plan. But when you're doing the executive summary, as I said, you're basically just taking the rest of the documents and distilling them down to the highlights. So I'm going to skip ahead a couple. The first section, one more slide, please. The first real section following the executive summary is about the company. This gives you a chance to say, this is our vision for the company. This is why we started it. This is going to be something I say a lot. Here's who we're going to target in terms of customers, and here's what their problem is that we're solving. Investors want to know that there's a stable market. And so anytime you can hit on, here's who we're selling to, and here's what those customers need, and here's why nobody else is filling that need, that's gonna pop up a lot, because that's really one of the most important things you can describe in your business plan. The next section we're talking about a couple paragraphs on about the company, a little bit of background, who's involved in the yeah, I'm sorry if somebody didn't get the template. I will make sure that that gets circulated. You can see, if you can see the slides, that's what it is. So for purposes of the presentation, hopefully that'll be enough, but we'll make sure everybody gets the template afterwards. Yeah, about the company. So get to know you a little bit, talk about if you've already formed an LLC or other entity, you can describe the legal structure that you guys are doing, or ownership, that sort of thing. Business strategies and objectives. This gives you a chance to go into what are your goals? What are the company's goals? Be specific, be measurable, targeted, things that you can show as you go down the line that you're meeting these goals. The next section is how are you going to do that? You said you want to accomplish X, Y, Z. How are you going to get there? The next section, we're talking about whatever product or service you're selling. I think back one slide, please. Thank you. So a little bit about the industry that you're operating within. If you can discuss the trends in the industry. I know that was something Tom mentioned. A certain market has been increasing over time. You want to highlight that here because that gives you the opportunity to say, we're in a growing market. We're going to have growing opportunities to sell. The next section is kind of an interesting one, existing alternative products. So here you want to get into what other products are out there like yours, but more importantly, why are they not good enough? What about the existing market is insufficient such that your product is needed? What will you provide that's better than what's out there? If you've already have, for instance, testing that's been done that shows, your product, your services is better in some way, you want to highlight that here because it's an opportunity to grab some attention. The table at the bottom just is in table form. You can really highlight the competitive advantages that your product has.
And by the way, for everyone, yeah, you should have all the handouts. Everybody should have received all the handouts, slides, etc., via email. So let Julie know if somehow it got hung up and you didn't get it, but should all be there. Go ahead, Chris. Thank you.
Thanks, Tom. On the next slide, we're looking at who your customers are, and what problem is your product going to cure. This just allows you a chance, when we touched on this earlier, but here's where you really get to go in depth. What is your product or service? I'm sorry, why is your product or service needed? If you can provide reliable statistics, that's going to be useful to the investors so that they can do modeling and see the opportunity for scaling and for future growth, which is really, obviously those are things the investor will care about. This section gives you the opportunity to go feature by feature and compare why your product is superior to what's already out in the market. To the extent that you can be specific and give numbers, both to the breadth and the depth of the problem, again, you're just showing the opportunity for growth and for scalability. The next section is describing the market, and we talked about the customers a bit, but this is just more about the size and the available market research that you might have done to explain the customer demographics in as much detail as possible. So again, we're looking to describe who exactly are you selling to? What does that group look like? Are they young? Are they old? You want to be able to show the investor that there's going to be a healthy, stable, maybe even growing market for your product, just so, as I mentioned previously, so you can show the scalability. And then get in a little bit into the marketing strategy. How are you going to sell to them? What methods are you going to use to connect your product with your potential customers? You can describe not just marketing strategy, but pricing. how are you going to set your pricing? How does it compare to what's already out on the market? And then at the bottom of this page, it gives you the opportunity to describe future growth possibilities. What other adjacent markets are there? Something that you could grow into over time. And again, this just goes to future growth that would interest the investors. So this section is related to what we've already discussed, but it tackles it a little bit differently. We already talked about competitive or alternative products. This is more going to competitive players in the market, but it's the same idea. Who's out there now, and why are they falling short? Why are you necessary to come into the market? What niche are you fulfilling in there? Why are you better suited to solve whatever customer problems you've already identified? Why are you best suited to solve those? So this just gives you a chance to describe those other players in the market and kind of go competitor by competitor. What are their deficiencies? Why are you better? And again, to the extent that you can be specific and detailed, that's always better.
Yeah. Chris, this is Tom. One thing I'd like to tell people when they're writing about competition is the absolute wrong answer is, I have no competition. I mean, there's always competition, even if it's consumer inaction, even if it's, you're so far ahead of the market that people don't realize they need what product or service you're selling. So I don't know if you wanted to take a second to build on that a little bit, Chris, but that's the one absolutely wrong answer, I think, in terms of how judges would look at this.
Yeah, Tom, thank you for that. So I was going to hit on this at the end, but let's do it now because it makes more sense to do so. One of the overlying things I wanted to mention was you don't want to paint too rosy a picture. You want it to be realistic. You want to say, here's the downside, or the negative aspects, the negative possibilities of our business. If there are good competitors in there, you want to describe them. If you're too rosy in your descriptions, you're going to lose credibility with the investor, and they're going to feel like, they can't trust your projections or anything like that. So always be conservative and realistic when you're putting these together, particularly, as Tom said, with respect to the competitors. I think the next section, the management team, this gives you a chance to let the investor know who's going to be intimately involved. I mean, at the end of the day, they're investing in people in as much as the idea or the product. So this gives you a chance to say, here's why you should trust us as people. So you want to mention the key people in the team, and you really want to include the information that's going to be relevant to the investors. Here's who the founders are. Here's who is going to be in charge of the day-to-day, the CEO. Mention any relevant startup experience that you might have. That's always viewed favorably by investors if somebody involved has gotten a project off the ground before. If there's any major IP involved, you might include whoever developed that IP. And if there's any really relevant third-party providers, really good relationships that you want to brag up a little bit, this would be an opportunity to do that as well. On that last piece, I just want to mention a bit from my practice experience. When we work with our private equity clients, when they describe why they're investing in a particular company, in the first sentence, they almost always say they trust the management. Something about the management is really what sparked their interest, just as much as the product or anything like that. So the management section is an important one because that's how you get to start to build that rapport and that relationship.
Yeah, I think Chris is absolutely right. I mean, when you talk to investors, they will say, they look at the entire company, but if they're given a choice between investing first in the team and then in the technology, they're kind of going to invest in the team, over that. So it's a big part.
Thank you, Tom. The next section, the capital requested and use of funds. So here you're doing a couple things. First, you're describing, what your current financing is, what past and current funding has the company gotten, if any, and then what are you asking for now? You know, what amount of funding do you need, and what are you going to use it for? You know, if you can't describe what you need the funds for, I don't think, you know, most investors are going to want to give you the money then. The table in the middle of this page gives you the chance to fill in some major milestones that you're hoping to hit. And what you're really trying to answer for the investor is, when are they going to get their return on investment? You know, what milestones are we looking at, and how big is that return on investment potentially going to be? You know, sort of a when and how much. And as I mentioned before, you want to be realistic on this, realistic and conservative. It does have a bit of a marketing feel because you want to draw them in, but if you miss by being too rosy, you're just going to lose credibility with the investor. I think throughout the plan, it's important to get feedback from trusted advisors, but this piece in particular might be a good piece to just run by a trusted advisor who's been through the process before. The last bit on this page gives you the opportunity to just project what future funding needs the company might need. You know, you've covered what you've gotten, what you're getting now. This is the opportunity for what you think you might need, you know, 6 months, 1 year, 2 year down the road. And if the answer is none, then you know, you can describe that if you think this is all you need for whatever reason. So the financial piece, I said at the outset, the two most important sections were the executive summary, which again is just sort of the highlight reel of the rest of the document, and then this financials piece. Ideally, you're showing the last 12 months on a month-to-month basis, as well as the next 12 months on a month-to-month basis. And then if you're able to project maybe 2 or 3 years down the road, that you don't have to do monthly, you can just do annually, but that's what most investors are going to be looking for. 1 year in the past, to the extent that you have them on a month-to-month basis, and then the next 12 months projection. As I said, you want to be realistic in this. You want to be conservative. If you can't defend the positions that you're taking, you know, if you get pushback from the investor, you have to be in a position to defend anything. Otherwise, you've lost all credibility. But this gives you, especially in the projection piece, you want to be able to convince the investor that they'd be getting into a company that's stable, and that you're going to show steady growth in time. So just a couple sort of in summary pieces before I open it to questions with what little time we have left. Make sure that, this is a small point, but an important one, make sure you proofread the document. You know, if there's typos, bad formatting, it's a simple thing, but it just kills credibility. They're going to think you're not organized. They're going to think you don't have attention to detail. So it's a small piece, but an important one to hit. I've said this a few times now, but be realistic at all times. Don't take any, you know, indefensible positions, because you'll get pushback. And if you can't defend it, then again, you've lost your credibility. And then finally, think about what assumptions you're making. If you can describe what assumptions you're making and why you're making them, then they're fine to make and the investor will understand. But just be wary of anything that's unsubstantiated or unfounded. If you can't defend it to the investor, then they won't accept them. So I know I went through that quickly with only a 30-minute presentation, but those are sort of the highlights. I don't know if there are any questions at this point.
Yeah, excellent job. And while we're waiting for some questions from the contestants, Chris, I'm going to pose a couple that perhaps would be on their minds. As you well know, not every company is suited for angel or venture capital investment. They're, for many, in fact, most, it's going to be some other form of investing. And how does that dictate their legal formation in terms of what type of company or entity they are? I think I often hear from investors who say, you know, they'd like to see a company be a C Corp, at least especially when they get to the venture level. And then, but an LLC may be perfect for for others. So any of your thoughts on that?
Yeah, no, I think that's exactly right. As you just phrased it, I think, if you're on the very ground level, if you're doing friends and family, maybe they're less concerned about that sort of thing. But that's a conversation sort of on a case by case basis that we enjoy having. And I guess it's sort of a plug. I think in the past year, or last year at least, one of the prizes for this contest was some free legal work with Reinhardt, and I was involved in that. So I think I'm hopeful that that'll happen again this year. So I would love the opportunity to have that conversation with one of you.
Yeah, that's good. Yeah, in fact, I think that is happening. So that's great. Thank you, Chris. And then, as you noted several times, be conservative, be realistic, be prepared to defend things. What how does that sort of contrast with the whole hockey stick approach that you often see on financial tables, where, by year 5, you've got some big returns noted, which I think, that's intended to influence investors, but at the same time, maybe it's not real. What are your thoughts in general on the hockey stick?
Yeah, I mean, it's such a balance to strike. I think at the end of the day, when you're projecting that far out, you're making assumptions, and as long as you can defend those assumptions, I think you want to be able to project growth, because that's what the investor is ultimately interested in.
Right.
But you just have to be able to. I mean, and this is something you can practice with a trusted advisor. If you get pushback on what assumptions you're making, you just have to be able to defend them.
Yeah, very good. This is a question from Jason, one of the contestants. What are the advantages or disadvantages to a straight equity type of arrangement versus a debt type of agreement?
Yeah. So debt can be helpful because you as the founder, because you're keeping the upside of all the equity, especially if it's not convertible debt. The downside of using debt is if it's triggering interest payments over time, that's a cash drain, and that cash can be better suited to growing the business. A lot of times you're hindered a bit by what the investor is willing to accept. A lot of investors will want the best of both worlds, where they get some money now and the opportunity to convert into equity if you hit your upside. The downside to equity, just straight equity, is if it's a home run, you don't get to keep 100% of it. So I mean, there's pros and cons, and a lot of it's going to be dictated at least somewhat by what the investor is willing to do.
Sure. Srini has a question. If we are working with multiple investors, do we need to have an NDA in place before submitting the business plan? Are investors reticent to NDAs at all? I think I have the answer, but Chris, you go.
Yeah, so I mean, I think some investors, if they get a lot of proposals, they may not, just as matter of practice, sign NDAs, just because they don't want to obligate themselves to hundreds of agreements. But it's a real question. Are you putting anything sensitive in your business plan that, if it got into the public sphere, would be, harmful? So I think it's sort of a case by case. What's in your business plan? And again, if you can get an NDA signed, that's great. But I don't know if all investors are willing to do that. Tom, I don't know if you have other experience.
I think it's rare that investors like to do that for the reasons you just described. I mean, otherwise they're signing, they might invest in 1 out of 100 plans they see, and they've signed 100 NDAs on, the real answer, I think, for most people on this is just don't put in the secret sauce. Mention that you have a patent pending, or a patent has been granted, or something like that. Chris, whatever you think there, but it seems to me that that's a better route than, just don't give away the secret sauce versus asking for NDAs that you may or may not get. And what that does, it signals to an investor right away that there's not maybe a trustful relationship brewing.
Right. Right. I think that that's right. And it's an understandable concern from the investor. They don't want to, a foot fault where they heard a presentation 7 months ago that they didn't make it past page one, and now they've, it looks like they might have breached because they are investing in something that's sort of similar. So I think that's right. Just be wary about what you're putting in there in terms of the secret sauce.
Yeah. And that's a good question, by the way, Srini, to ask maybe some others. You might, Jonathan Horn when he's in, or Nick Mastronardi, who's up next. And you could ask Nick whether he signed a lot of NDAs or any. And the same with Jonathan as an investor. So,
sounds good, Tom. Thank you. Appreciate it.
Yeah, absolutely. So but a great question. Another quick one before we probably need to go, Chris. I'm sorry we're keeping you over a little bit. How much protection does a provisional patent provide?
Yeah, I'm unfortunately not an IP attorney, so I'm not super. I think it's better than no provincial patent, but again, I think that's just a bit outside of my scope of practice. Apologies.
Yeah. Okay. Yeah, and again, maybe we can ask that of some others as we move along. Or, Jason, I think in particular, we do have a number of mentors who are part of the contest structure. And basically, I'd say this to everybody: feel free to ask them whatever the heck you want and in much detail as you want, because they've really stepped forward for that reason, to be helpful. And I know there's at least one intellectual property attorney among them. So, it's a great question. Okay, well, Chris, are any closing words here? I mean, I think you really hit all the high points there. I mean, the notion of competition, who are the customers, how are you going to make sales, how are you going to grow, what are some of the potential pitfalls that you might hit in terms of formation and all of that. So really appreciate it.
Yeah, no, I appreciate the opportunity to speak this morning. I apologize, I kind of went through it quickly, but just only a 30-minute presentation. And I just want to say, good luck to everybody, and I look forward to hopefully working with one of you at the end of this.
Excellent. All right. Well, thanks, Chris. We'll see you a little later then. Okay. Take care.
Yeah.
Bye-bye. All right. Well, I believe on deck now is Nick Mastronardi from Polco. Nick is an entrepreneur. He is an Air Force veteran. He is someone who has done a lot of work around public engagement, but in this case has turned it into a company that has a lot of traction right now. And he was among the finalists in the 2016 Governor's Business Plan Contest. And so I'm thrilled that Nick could be with us today to tell us, a little bit about how the plan was at the time, what's reality now with Polco, and some of his own experiences. So be ready for questions to Nick as well. Nick, are you there?
I am. Can you hear me okay, Tom?
Excellent. I see you too. Thanks, Nick. Thanks for joining us. Are you in Chicago today, or?
I am here in Middleton, in our world headquarters of Middleton. So, yeah.
Greater Middleton, as I'm told it is. So, all right. Well, Nick, maybe if you don't mind, a little more on your own background. But as you know, this presentation's here, and your goal today is to tell them how you did it and how you got to the top in all of this. So take her away. Thank you.
Yeah, sounds good. Great to meet everybody. First thing, I'm happy to answer any questions now or later. So you've got my contact information there on the screen, so feel free to use that to follow up with me. This session, which I prepared for, was how to win the Governor's Business Plan competition, and we were the 2016 IT category winner. And I have to say it was really helpful to us as the process itself in preparing for the contest itself was really valuable to us. The presentation and the success and the notoriety that came from that gives you a lot of momentum, and everything in entrepreneurship is about building on momentum. Anything you've got that you can capitalize on, I know the Wisconsin nature is to be humble, but you got to capitalize on any little bit of momentum that you've got. And if things start eroding, you got to be prepared to stem that tide, but this is a great chance for you. to get some positive momentum you can build a company around. So with that said, I don't know who's got, if you got access to the slides there, Tom, and how we should advance.
Very good. There we go.
Cool. So just a super fast, if you go back one slide, actually, it would be awesome. Background for me is former public servant. I think as Tom mentioned, I was in the Air Force 10 years. I worked for Amazon for a little while, always loved technology and public policy. And so the opportunity, I felt there was really a strong business need to improve communications around public policy topics. And there's a lot of potential buyers and users in this space, and so we've crafted a platform basically to help bridge communication between city officials and city residents. And so I'll share more about it. I'm not going to pitch the whole company to you guys, but that was just kind of the impetus for us behind what we did. I think for you guys for this session, again, which is how to win, I think if you're probably like me in that you're a founder and a builder and a tinkerer, and I love doing my building and technology. You know, when I was at Amazon, I was writing advanced data science and pricing algorithms, and all that was fun. And so we were able to build this platform, but you have to become comfortable and familiar with sales. And that's just all there is to it. If you're not comfortable and familiar with sales, get yourself a great sales book. I mean, I can recommend you a couple. To me, the one that really turned the light on was a book called Pitch Anything. And realize that, yes, your company has to sell product to customers, but what you're doing in this business plan competition and with your presentation is you are looking to sell shares or ownership of your company to prospective investors. So if you're not employing sales best practices into your pitch, don't expect to win. If you want to win, use some sales best practices. And that's not just the content of the slides and things, it's how you tell your story. It's the energy that you bring. And so I want to focus just on a couple things, at least from that book, Pitch Anything, which I think are really so important. And Tom, if you don't mind, or whoever, I think the next slide starts to get to that a little bit.
There you go.
One of the biggest takeaways in the book, Pitch Anything, which I had read, it helps us in our sales, it helps us with our fundraising, is just make sure that you have a clear story, a developing narrative between what the status quo is, where the problems, and how what you're doing is going to change the outcome for that. If that, you know, to be convincing in sales, you need to be clear. For you to be clear, you need to understand it. They need to understand where you're starting from, where the problems are, and where you're hoping to get to. And so that's just, you know, we try to do that up front on this slide right away, and we'll give more detail to it. One of the other important things in the book is that basically have two levels of your brain. There's a lot of people who have written about thinking fast and thinking slow, the croc brain or the neocortex, or all the difficult thinking happens. You want most of your pitch to be in the croc brain, like your crocodile brain, the really low brain, where it's just really easy for them to glom onto the emotion of your narrative. And yes, there's going to be some things that they need to use their higher brain for, their neocortex on. Maybe it's market, maybe it's price point, maybe it's market size, whatever it is. Don't spend a long time there. Make sure it's clear and they feel like you've done your research, but the longer you're there, the more you're going to lose them. And I'm probably about to lose you because I'm appealing to your neocortex with what I'm saying there, so I'm going to back off of it. But just be aware and use those techniques. So what we were doing here in this presentation that we gave is actually great for me to look back and see this, is right up front, we're showing real pictures of the emotion, the pain point, right? When you're painting the problem, they should be able to see and associate and feel the emotion of the problem that's the status quo in your market today. And so whether it's these residents who are there presenting and have anger, or the people around them, or it's how you feel, something that you might go to, or even appeal to the city manager, who's ultimately our buyer, that they don't know what to do in this noisy environment, I think it's just a great way to start, and it helped us. And then just as a counter to that, you know, they don't want to know the features of the technology that you're bringing. They just want to know that it turns a noisy, painful environment into something that's actually makes people happy and feel better together. So you'll notice, right, like right away, you don't know anything about Polko, but you know it's taking this real pain point people can associate with and turning their frowns upside down, and maybe some buzzwords to go with it. So next slide. Okay, so before I dive into this, I think one of the key takeaways is as you have all these investors, there's going to be some really sophisticated later stage venture investors, and they're going to want to make sure at some point you have all your I's dotted and T's crossed. But likely for the stage that you're in, you're trying to win an angel or a seed round investor. And a lot of these angel and seed stage investors want to present to you as if they are a later stage venture investor, and they're going to want to say they did their due diligence, and they will. They're going to take a look at things, but really at the end of the day, the motivation of an angel stage and seed stage investor is quite different than a later stage venture investor. A venture investor wants to know all your sales metrics and KPIs and scalability, blah, 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 and they just want to pour money on and see the engine turn faster. What you are looking, and so look, we're gonna put that stuff in here, but really what you're looking for is an angel or a seed stage investor who wants to be part of the drama and the journey and the excitement of what you're doing alongside you. And I heard it explained to me once that you know, a lot of these individual angel and seed stage investors, they like to just be able to tell at a dinner party with their friends that they're an investor in this company that's working to fix this problem. And this is not their major revenue source. They just want to be involved in helping the local ecosystem and having some fun stories to go around with that. Yes, they don't want to invest in something that doesn't check the boxes later, but make sure you appeal to that angel and seed stage investor. But a good way to do it is let's make sure that we tend to the big numbers. Again, don't want to get caught up in the neocortex, but hey, are there a lot of potential customers? What are they currently paying? What are they currently doing? And what does it, make sure that translates into a big number, enough to show you did your homework, enough to show that the market is big enough. Don't overdo it on this slide. Next, if you don't mind. Okay, so we talked about the problem. We talked really high level at the solution. That solution is very different from the product, right? The solution was making people happy. We talked that it's a big market. We've got their interest. Like, oh yeah, if you can actually do this, you can make some real revenue. Tell me just something about the product. Is it real? Is it vaporware? And so that's it. Like you can see from a quick screenshot that we present some policy polls, little e-ballots online, people that can take, and then it turns into on the back end some really useful data. And you can see how it manifests and a little bit of snapshots of it. Do not go into the details here. You'll go to the neocortex and you'll lose people. Just enough where they can get a high level understanding of what's happening. Next slide. Okay, all right, let's say you've checked the first boxes. There is a problem. A solution would be nice. There's a big market. Your product seems legit. They'll dive into it in more detail. Now, growing a business is a lot more than just the product itself. They want to make sure that you and your team have rounded out the skill sets that you need, and you come from backgrounds where you've seen really good things happen, and you can replicate some of those. So, and we probably had too many people on here, you know, advisors. I guess if you can have a couple of advisors and you can bring with them the brands that they represent, that's really good. They just want to know that your associations are world class, and that big market opportunity, for whatever reason, you are the ones to proliferate through it. And so just a couple blurbs, don't need to go into everybody's background, just something that associates some credibility and some world-class organization affiliations.
And Nick, this is Tom. Was that the team at the time in 2016? Or is
That's right. Yeah, yeah, but I think, you know, Gavin was, if you look on the team on the left side, right? Gavin was a law student at Notre Dame at that point. And so I went to Notre Dame undergrad, and they had a program where you could work with current students as interns. He was an intern, but right, it looks good, you know, Notre Dame law. But I think everybody else, actually Dana was still at Amazon, but he was doing some sales with us part-time. But the other four were full-time. So, you know, just tell your story. Again, all it has to be succinct, has to be compelling, and extract what you need from doing it. Again, the last thing on that topic is, the more I think they say the more you write a novel, the shorter it gets, the more edits and revisions you do. Same thing has to be true in your deck. The deck, continue to re-edit and reduce the blurbs, the bios, the bullets, everything you can reduce, the cleaner it's going to be. And then also, re-practice the presentation, and you're going to find you can tighten your deck down and make it really strong. And then if you do that, you can tell little jokes in it, and it makes it stick better. And the emotion from your deck is what's going to really leave the impression on the audience and help you be successful and win.
Right. And Nick, if I may, I want to add one thing here, just because I don't want people to be overly intimidated about the team aspect. You got 9 folks here, right? But they may not. They may have 3, 4, or none. But in some cases, as they move ahead, that will fill out during the course of this contest, number one. But also number two, just recognizing that there are parts that team members that you need, advisors that you need, and they can be purely advisors in certain areas where perhaps you're not as well versed. So, it's there's a lot of ways to portray the team sense. It just got to make sure that the judges know that you understand that.
100% agree. You want to present that you're rounded out, but you really can do that with 2 people and a couple bullets, maybe 1 advisor. So absolutely.
Right.
Next slide. Okay, so if you're thinking again about the narrative, is there a problem? Is there a solution? Okay, maybe there is. Is the market that this solution addresses big enough? And is this the right team? Give me a little bit more about the product. Does it seem real? Is it vaporware? Is this the right team to pursue that big market opportunity? And now, have they made this, the whole goal of this slide is, have they made any progress today? And so at that point, we were really small. We had a couple cities, counties, and that's great. It's hard to get them. That's a hard product to sell because the city's going to go live and they're a really kind of important organization with a brand reputation. But I think at this point, it looks like we had 6 cities on contract. And so, but we also had a lot in our funnel. So figure out the best thing from your traction, which doesn't mean necessarily they've come out the end of your sales funnel, but maybe they've made some meaningful progress throughout your sales funnel, which is what the yellow dots represent. Again, the whole goal of this slide is that not only can your team execute on the market opportunity, but you've made a couple steps in that direction so far. And partners can be a good indication too, right? Like different groups that we had endorsements from the National League of Cities. Those are strong brands. They say a lot with just a few things. And so anything you can do to tighten your deck and your presentation to lean on that brand credibility, go for it. Next slide. Again, this is one of those ones you can be really careful. Don't get caught up in it. They know that these projections aren't going to be accurate. Now looking back at it, this is probably a little ahead. That table I didn't need to go into as much quarterly detail. Maybe 1 or 2 points out 1 year, 2 year, 3 years would have been sufficient. They just want to see that you've thought about it and that things are moving in the right direction, and it can be big and it can get there fast. So they're looking, again, if you can do maybe 2 or 3 columns on a table like that, evidence some big numbers that are realistic, and you can answer them in Q&A that they're justifiable, great. If you can throw it on a graph and they're looking for some sort of hockey stick shape within a reasonable time frame, great. And they want to see too, kind of where do you get to on that trajectory with the investment that you're seeking, right? Am I going to invest now, but you're going to need millions and millions more dollars now? Just how can you get somewhere that evidences some progress with the amount that you're raising? So looking back now, this slide could be quite a bit cleaner, fewer columns, and then less annotations on the bottom left. And then probably also more prominent, the content that's on the bottom right is really what the investor is looking for. And like, if it seems you can get somewhere in a reasonable amount of time and you don't need too much money, what are you actually giving me in return for that? And so in that bottom thing, just a mistake I often see here is that people ask for too little. Our seed round investment, I think we set at 350K and we were 70% committed. That ended up growing, and I think it ended up becoming between 1 and 1.5. And there were people who say, that's too small, you're not going to get far enough. And they're right. It takes a lot of cost to run a business. Don't be shy. Make an ask, and there's groups and there's a lot of amazing people out there who want to help you financially in other ways. You'll be surprised how far you can get if you follow some of these best practices. Next slide. All right, and then, you know, at the end of the day, they're like, where is this going to end up going? What is the last slide is kind of what is this investment opportunity right now? And if we do that, what am I going to get in return from that? So the seed round milestones on the right is here's where we're going to go, customers and revenues. And if we do that, then we can be, you know, even more venture fundable. We can be on that Series A, B, C path. And even beyond that, this is something that has acquisition options. You don't have to commit, and some investors don't even want to know that you're thinking acquisition might be premature, but just that it is something that is potentially valuable to somebody to buy at some point, or maybe even IPO, right? But there's some way for investors to get their money back. And so that's the whole point with this slide. Next slide. And that's it. So I like to end that way on that last slide, because it kind of, if you go back one, because it gives a taste like, oh yeah, the single most, back one more, the single most powerful element to an investor from your presentation, and do not leave this out, is the power of FOMO, the fear of missing out. So if they're convinced, you've checked the box and everything else, and you're saying this is a big thing and I'm going to pursue this and I'm going to grow big enough that I'm going to be competitive with and a acquisition target of these organizations, they're going to wish that they had capitalized on their opportunity seeing you at the Governor's Business Plan competition to drop a little bit of money on and be a part of that success story. So I like to end it there, because FOMO is the most powerful, convincing element, and this is a good place to instill it. But with that, that's all I had, and I'd love to answer you guys' questions. And it looks like there was one flowing in. So let me.
Yeah, it was a question about your deck, and yes, it's available. We sent it to everyone, I think in a PDF form. So Nick, that's fascinating, and thank you for joining us. A couple of questions came up earlier that, you know, they've heard one take on it, and I'd just love to hear yours. When you were working with investors, and I realize you still are as you move ahead, did you sign NDAs?
Never signed an NDA with an investor.
Yeah, that was my guess at that point, that's not that common.
I think I will put one caveat on that. If you are looking at a strategic investor, so this is a company who operates in your space and could be a competitor. So I'll just give an example. Now is like, we are looking at, it would be as if SurveyMonkey wanted to invest in our current growth financing rounds. And we would not want to give all of our details to SurveyMonkey, and they would be able to infer just because they know our industry so well. Then I might want to do an NDA with SurveyMonkey. But for where you are, unless it's a big organization directly in your field, it's not usual practice.
Right. And we can ask the same thing of Jonathan Horn a little later when he comes on, which, by the way, Nick, you're more than welcome to still stay and listen to Jonathan too. I forgot your IP at the time, where you were at in 2016. What did you have? Because the question that came up earlier is, what's the value of a provisional patent?
Yeah, if you're in software, pure software, you might not have explicit patents, but ultimately what they're looking for is some sort of competitive advantage, whether it's a first mover advantage, or maybe it's network effects that if you crack in, it makes it harder for other competitors to crack in later. And so we did not have any explicit patent, but we do have really strong, we do city benchmarking. It makes it hard for anybody else to come in first mover. We have exclusive endorsements from key players such as the National League of Cities. So you can talk about those probably back, like I mentioned them in the traction slide here. And competitive advantages are important. It's worth mentioning. If you can do it quickly on its own slide, maybe go for it. But
yeah, okay.
I think that's the biggest thing I'd say.
Yeah, very good. Do you have any rules of thumb, or just in your own experience, about how much equity you may want to or need to give up in return for an investment?
Yeah, I will say I was probably a pretty big outlier early in that when we were coming up, almost nobody was doing convertible notes. And so I'm happy to discuss in more detail with any of you after this, if this is in the weeds or it sounds like I'm speaking another language. But when you're an early stage company, it can be really noisy and difficult to come up with a fair valuation. If you do know what your valuation is really clearly, and say, hey, I think we're a $2 or $3 million company and we're raising this, if it's 500K and you think you're a $2 million company, then after they invest their 500K, they would have put in 500K of the resulting $2.5 million company, right? And so they should own a fifth or 20% of that. But if you don't know that you're a $2 million company, a lot of times the way that it's handled is a convertible note. And so they will invest, you can keep track of some interest in the meantime, and later down the road, when the valuation is known, you will give them their principal plus their interest at a discount at the valuation of what other people are investing in that. And I think for us at that point, it was really a good deal for us and our investors to punt on the valuation conversation. In other cases, if you know it, great. But I have seen some companies that didn't know their valuation and then undervalued their company early. And that ended up making it hard for them to raise funds later because they'd already given up tons and tons of equity. So just be conscious of that. It depends on your company, it depends on your industry, and I'm happy to discuss that with you in more detail. Don't cut off your nose to spite your face. Don't cut off important financing that you need. Ultimately, it's market determined, but just be careful and try to be smart about it. There's plenty of people around who know that information.
Very good. Thanks, Nick. One question we had, someone noted that, there was a fair amount of type on some of these slides. Was that, basically because you suspect that investors or others are going to refer back to them later?
Yeah, we always went back and forth on this. And I think this was at the point before we split our deck into two versions. We ended up having a presenting version of the deck with much less text, and then we would have a share copy of the deck that could answer some of the questions that were naturally begged. So yeah, there is a lot of copy in here, and it's probably because we didn't split yet. But if you can make the split, it'd be really smart. It would be really, really good to do that.
Okay, good. And fear of missing out. I mean, you're right. I mean, a lot of investors would love to be in at an early stage, right? And how many times did you kind of experience that feeling in talking with investors?
Oh, I mean, I feel like that is very simply we were also a winner of the pressure chamber that year.
Yes, right.
And I think the 1-2 punch between this and pressure chamber was really powerful because we won this and then we won pressure chamber, and part of pressure chamber says, hey, we're going to set up meetings for you out in Silicon Valley. And at that point, one of the good ways to represent FOMO is we're going out to the big funds. So if you're an angel or a seed stage investor and you want to get in, now's your time because we're about to do our big reveal to the coast. So it had some natural FOMO built in. But if you're leading up to a big deal with a customer, if you're leading up to a big deal with a partner, whatever you can to kind of impose that forcing function and say why now is an important time. And all this is in the sales books. If you're not capitalizing on that FOMO, you're missing a real opportunity to kind of induce participation from an investor.
Yeah, very good. Well, excellent. Thanks, Nick. I think you saw on the next final slide, Julie, if you want to move up to that, I think it's just Nick at polco.us, if I recall.
Yep, Nick at polco.us. And Yeah, there at the bottom. And I just want to say, like, well, I don't know, dreams do come true or whatever. We were a small little group working on something at that time. And now we're a team of 33 people and working with hundreds of cities across 40 states. And give a lot of, there's no shortcuts. You have to do the hard work and take the steps along the way. But if you keep plugging and doing quantity and quality hard work, it certainly comes through. So I'm appreciative for the opportunities I had. Tom and all that you guys have facilitated. So I'm happy to do it. And I'm happy to continue to help others coming up along the way. Don't hesitate to reach out.
Oh, great. Thank you so much, Nick. And yeah, what a great story. I mean, like you said, now you're up to 33 members on your team, 100 plus cities, 40 different states. And so that's great growth.
Yep. Yeah, I appreciate it. Thanks so much.
All right. Well, thanks. Thanks, Nick. And like I said, feel free to hang if you want to hear a little bit from Jonathan. And that's who's up next.
So I'm going to hop out, but I will say I learned a lot from Jonathan. His presentations are really good and helped build some of our early version of the financials, which is often something somebody's going to take a look at prior to investing. So I took good notes and encourage you to do the same.
All right.
All right. Have a great day. See you later.
Thank you, Nick.
See you, Nick.
All right. Well, there we go. There's the aforementioned Jonathan Horn. How are
Hi.
you, sir? Good to see you today.
Yeah, great to see you. Thanks for having me.
Yeah, well, yeah, really appreciate you being here. And, you know, today, as I think you know the agenda, I mean, we've heard about, you know, the kind of the basics, the constructions on a business plan. We heard from Nick, who was a past category winner in this very contest and has gone on with the POCO to do some great things. And Jonathan's going to tell us a little bit on the investment end. Jonathan has a great background. As I told people earlier, the Idea Fund of La Crosse is a part of that umbrella with the Badger Fund of Funds, which has been up and running. And I think the Badger Fund of Funds is now invested in somewhere between 25 and 30 companies. I don't know the exact, right around there, right?
Yep, that's right.
Yeah, and Jonathan's background has been around finance and entrepreneurship and all the various moving parts associated with that. Based in La Crosse, as the name suggests, but looks broadly at companies around the state. So I'm going to let you take it away. I might, you know, that people may raise questions somewhere along the way. I might add something, whatever. But Jonathan, yeah, let's have you get her going. I appreciate it.
All right. Yeah, thanks for having me. Glad to be here. Glad to catch the tail end of Nick's presentation too.
Yeah.
Yeah. So look, thanks for having me. I'm Jonathan Horn, manage the Idea Fund of La Crosse. Please feel free to jump in with questions. I think we have 30 minutes here.
Mm-hmm.
So I want to make it as useful as possible for you all. Basically, what I put a few slides together here. I think what's an investor looking for? You know, anytime you're negotiating or trying to find a partner, I think it helps to understand, you know, the other side of the table. So I tried to give you some information here on how, you know, typical venture capital funds, what their motivations are, how they think about it, where incentives sit, all that kind of stuff. So welcome questions as we go through this, and Tom and others, please feel free to jump in and supplement or correct. Okay, so Julie, are you controlling them or do I flip through here? Great. Okay, so I gave you a couple of slides at the beginning here just on, you know, why we do what we do. I mean, we're like Tom mentioned, we're a venture capital fund managing third-party capital. So we have 28 limited partners that have contributed $13 million to our first fund here, and you know, we're a returns-focused fund. I'm a fiduciary for my limited partners, so my job is to generate investor return. But I think the reason that I'm in it personally, and I think the reason a lot of our investors are involved in this, is they want to return on their capital, but they understand, you know, the really good things that happen when companies like yours succeed. I mean, these are, you know, companies solving important issues. A lot of jobs come out of this. I mean, we have 11 investments at various stages, and somewhere around 50 people, 60 people working across the portfolio, just in Wisconsin alone, plus, you know, contractors, service providers. I mean, there's a really significant economic impact here. and it impacts the communities too that we're all involved with. And so, and Julie, on the next slide, we try to be really intentional about how we do business. It's really important that it's about more than dollars and cents when you're launching one of these businesses. I mean, your work is extremely hard. It can be really rewarding, but it's long hours. It can be lonely, and you got to remember this is something about more than just the dollars at the end of the day. And encourage you all to, and I'm sure you do, set your vision with your team, because as you scale, you really have to be intentional about who you are as a company, what's important to you, how you all operate with your employees, your customers, your suppliers, everything like that. So on the next slide. So just some nuts and bolts here. Like I said, we manage money for third-party investors. So they're called limited partners when they're an investor in a venture capital fund. It's a venture capital fund is different from an angel group in that we have limited partners. Angels. So when you come to raise money from a venture capital fund, you talk to a manager and they've got whatever internal decision-making framework a manager has. But then once that's satisfied, you get your check. An angel and the limited partners are obligated to send in their check. So once they sign up, they don't have a say on whether they invest in any particular deal. An angel group's different, where typically you'll sit down with all the members of an angel group, and you'll have your presentation and your investment opportunity, and then they all elect in individually. So it's little different framework from that, and that's kind of the definitional difference between the two. And again, each of the angels is making their own decision. Here I'm operating on behalf of all the limited partners. All right, next slide, please. And then our objective. So very simply, it's investor return. And when you think about this, I want to just give you a minute on how you think about investor return as a venture capital fund. So you see here, these are just historical returns to different asset classes. So you see, and when you think about these, they're really the higher the return, typically the higher the risk, and lower risk, typically lower return. So on the bottom there, you see bonds, historically, a lower return, lower yield on bonds, but also much lower failure rate. Typically, it's a liquid market. So if you want your cash out from, a bond fund or the market from the S&P or something like that, you can sell it and you can have cash back in 3 days. You invest in an ETF or a mutual fund, you get exposure to hundreds of companies. They're large, they're diversified. Any number of factors that decrease risk. When you move to the top of this slide, and this is the top of this table, and this is where you all are, it's a highly risky investment. In fact, when you invest in a startup company or a venture capital fund, you typically can't get your money out until there's a liquidity event. So it's basically out of your control. It's highly concentrated. There's high failure rates, any number of issues that increase the risk of an investment. So, in exchange for that, investors typically say, hey, I need a higher return for this. Maybe you can think venture as an asset class is mandated to return, say, 2x the market, something like that. So if the S&P is doing 6-8% a year, an investor in a venture fund wants mid-upper teens annual return, something like that.
Mm-hmm.
So, yeah, go ahead.
Jonathan, yeah, I often say that I think venture capitalists, in terms of that return and the success rate, it's kind of like a professional baseball player. If you hit 300, you're probably an all-star.
Yep.
And a couple of singles maybe, and a home run among those 3 hits.
Yep.
That's kind of the world you live in, right?
Yep, that's exactly right. And remember, this is portfolio return. So this isn't, to Tom's point, this isn't the return from any one investment. If you go to the next slide, we got some data on this.
Yeah.
Actually, why don't you flip forward? Yeah. So this is Tom's point here. This is a study, really interesting data from CB Insights. You can find it online. It was about 1,100 U.S. tech companies. I think we got formatting a little messed up, but hopefully we can track it. 1,100 tech companies that raised around, like what you're raising, like what you would be raising, a first 500K, several $100,000 type investment. And this tracks them through the subsequent rounds of funding. And what you see is out of this first 1,119, 427 failed to raise their next round, 38%. 158 were acquired, 14%. Then another about half of them raised the second round. And so what you can see is just out of the gate, you have about a 40% failure rate. Fail to raise can either mean the company totally goes out of business or just kind of continues indefinitely, which isn't necessarily a bad result for the operator, but for the investor, there's typically no return of capital in those scenarios. So that's generally a loss for the investor. So you see, right off the bat, you lose 40%. Off the second round, you lose another 11%. And when you kind of sum up the CB Insights data, you see about 3 out of, just exactly what Tom said, about 3 out of 10 on average realize an exit, and 7 out of 10 do not.
Mm-hmm.
And so maybe Julie, you can go back a slide. What an exit means. Nick was talking about this too. So typically the way we get capital back, your investors get capital back, we don't get a salary, right? So it's typically through sale of the business to another corporation, to a private equity fund, something like that, or through an IPO. IPOs are on the high end becoming a little more common this year. I think there's 5 tech IPOs scheduled, upcoming. That's a significant amount of IPOs for our country. You can see on the bottom right, there are some stats of an average VC-backed IPO. On average, they've been, and these numbers have probably actually ticked up since I ran these, a year ago. But 11 years in business, $3 to $4 billion market cap, $400 million in sales. So these are really large results. What's not shown here is how much capital they've raised. Typically, you need somewhere in the range of, 20% of your market cap you need to have raised in investment capital. So every, $1 billion of market cap, you probably raise $200 million of investor capital. So this is, big businesses have raised a ton of capital on a very, very outlier result. What we see there in Wisconsin much more typically is sale of business when there's an exit. So that's, that's typically that's what we solve for. We're not underwriting anything to an IPO. So if you want to go ahead 2 slides from that, this is more data about the magnitude of the results, and a different data set, but similar story here, where this is the gross, this is the return multiple frequency. So what you see here on the left-hand side, 60 in this data set, I think it was like 20,000 investments somebody tracked here. Out of those, there was 64% return 0 to 1x invested, so less than investor capital, either a partial or total loss of investor capital. 18% return to 1 to 5x, 6% 5 to 10, and you can see the distribution of results. So when you think about this and you see the upper teens 20% net return off a portfolio, that typically includes 64%, 70% that are either partial or total losses. And that's when an investor is thinking about your business plan, the question most venture investors are going to be asking is, can you access the right hand side of this chart? And we're willing to take the risk that you're in the left hand side if you see that there's a pathway to this big result that's really going to drive your return. What a typical venture fund, a successful one, what you don't see is a really high batting average. And there's other data, I don't have it in this deck, but the funds that do well, it's not usually because that 64% is 30%. It's because they have one bigger one, one or two really big ones on the high end. And that's kind of the portfolio theory behind how investors typically look at the return potential of any individual business.
Yeah, the home runs.
Yep, that's right. So when you hear about market size and scalability, and that all plays into the question of, does this company have a shot at accessing that right-hand side? A food truck, cool business, love them. You're never going to see venture investment into that because there's just no potential for the right-hand side of that chart.
Jonathan, am I correct that the stats on this are still roughly, maybe 1 out of 10 companies will see, even an angel investment. And then a smaller percentage of those who have the angel would see a venture investment. So it's not for everybody, nor should it be, right?
Mhm. Yep, that's right. That's right. I mean, this is what a venture fund's typically looking at. It doesn't mean this is what a good business is. That those are two totally different things. The question with are you venture fundable is, do you meet this return profile typically? And that's, it's just a small portion of businesses. And honestly, it's not every founder that wants to do that either. Some founders, very good lifestyle. You can have plenty of very good lifestyle businesses that just don't fit the return profile or don't have the management disposition to go after, these kind of returns.
Mhm. Very well.
Okay, can go on to the next one. So this is our portfolio. We haven't announced all of these yet, but we've got 11 companies in our portfolio. So Tom said 25 to 30. I think that's about right across the Badger funds that are investing. These are the 11 that we've done. So they're, like you said, we're all in Wisconsin, but we're investing throughout the state. Got up in Eau Claire, West Bend, several on the west side of the state here. You can see the industries in there. I mean, I'm happy to talk about any in more detail if people are interested, but basically what we're looking at is primarily technology businesses, but operating in the industries that, diversified set of industries you can see on the right-hand column of that chart. And it's typically industries that we're strong in the state here, that we've got a real talent base. And that's something we look really closely at is, the founder's background and their understanding of the industries that they're building businesses in. So, Part Analytics is a good example. These were two people from the co-founders were supply chain engineers from GE Healthcare. And they had a real understanding of, it was a real problem that they're solving a problem that they saw in their jobs. And it's something that you've really got to be steeped in the business to understand and generate a solution for. That's the kind of stuff we really get excited about is people that are deep in these industries.
Yeah. Jonathan, may I spend a second here just talking a little more about Badger Fund of Funds?
Yeah, please.
So Jonathan is one of 5 funds that are under, at least currently, under the Badger Fund of Funds umbrella. There may be more to come. And so there's the Gateway Fund, which is Milwaukee, Dana Guthrie. Winnebago Seed Fund, that's David and Nina, I think is his actual address. Rock River.
Yep.
So that's Andy and Christopher. And then the Winnow Fund, which is Rochelle Martin. And the Winnow Fund is sort of a circuit rider in a way. I think she's trying to look off a lot of, campuses around the state.
Yep.
And I think like you, for the most part, they're kind of, you're kind of sector agnostic. I mean, you've got everything here from medical device to ag tech to fintech to publishing. And I think your colleagues in the other funds are more or less like that as well.
Yep, that's right.
Good. So but it's been a great addition to the overall early stage investing market in Wisconsin, which when we first started our Tech Council Investor Networks, and Joe Kramer is, I think, back on, and he was a big part of that.
Yeah.
There were half dozen or so, investor groups of any description, angel or VC. Now there's, about 50 if you count corporate and family offices and things like that. But anyway, Badger Fund of Funds has done a great job reaching out around the state. Yeah,
we've done. It's been really fun. I mean, there's one of the big success factors we pointed to, is ultimately you're looking for exits, which take time, and I think they're in the works. But we've been able to attract out-of-state capital too. So typically we'll do the whole seed round, $500K initial investment, and then as a company gets traction, they'll go out and raise, their next round, say $1 to $2 million or something like that. And we've attracted in I think every company that's done a follow-on round, we've gotten out-of-state capital. Which is really important. I mean, we've been a donor state for too long in terms of capital, and you're really starting to see other parts of the country look at Wisconsin and see their real opportunities here.
Excellent. Thank you.
Yeah. Okay. You moving on? Okay, so this is, again, Tom, to your point, this is our deal funnel since we launched in 2017. So if you think of, all the deals that came in the door, everybody that sent me a 2-page summary said, hey, we're raising money. That's 100%. About 30% were out just because they were either too late stage, out of the state, just didn't fit our investment profile. We brought about 4% of these to my investment committee, and then 3 of them ended up closing. So, and this is pretty typical for a venture fund where you're investing in, low single digits % of your total deal flow. So, know when you go out there, just because somebody tells you no, or a fair amount of people tell you no, doesn't mean you're not going to get your round raised. So, I mean, we've done, when we first launched, we invested in companies that had been out raising for a long time, to be honest. And, Curate, our first investment now went from $6,500 a month to $95,000 a month right now. They've raised a really successful round from out-of-state investors. So just know these. It doesn't look pleasant looking at the 3% number, but it's just the reality with this. So don't be discouraged if you get no's. I mean, incorporate the feedback, right? But know that people disagree on this, and one no doesn't mean everybody's gonna say no. And then the other point to make is this 30% that I didn't do diligence on. It's key to understand where the investor you're approaching typically invests. So our profile is typically the first 500K, and we'll do maybe 5,000-10,000 a month in revenue, but we'll go as early as pre-revenue. Other investors will say, hey, talk to me when you're at $500,000 a year in revenue. And if you're just starting out, you got 5,000 or 10,000 a month, you would be in that 30% that they just wouldn't even look at. That it's just not a fit for their strategy. So it's something to think about. Like a 4490 in Wisconsin, great investor. They're looking for much later stage stuff typically with more traction, and they can raise a $3 to $5 million round. So it's something as you put your target list together to really zero in on. All right.
Excellent.
And then, how we invest. Again, these are the reasons we passed on an investment. So you see that, that 30% or so that was just outside of our focus. Outside of that, once we've dug into business, the biggest thing I'm looking for is management. And I mean, the more I've done this is my first fund. We launched in 2017, made our first investment in 2017, and now we made 11. The more I've seen these companies progress, when things don't go well, it's typically not because of the product, and it's typically not because of the market. It's execution. That's what it all comes down to. It's all about you as the founder and the people that you've brought into the team. So, certainly in your investor pitch, but also more broadly in operating your business, really encourage you to think about, do you have the right skill sets here? Where am I strong? Where am I not strong? And really think honestly about that, and where you can supplement yourself. So happy to talk on any of these in particular, but that's the key point here is it's all team.
And that builds on something they heard earlier, Jonathan, about management. I mean, the team is so important, whether it's getting an investment, from somebody like you or angels or just, other types of debt related investment. It comes to the team many times. Yep,
absolutely. Okay, so the next slide and the final one, I wanted to talk math here for a little bit because I think it's one of the things that is maybe least intuitive for very early stage companies, because people say, well, how am I going to know what the future holds and all that? So what I really encourage people to run, and to Nick's point earlier, how much equity do you give up? How much? What's a reasonable amount of equity for your investor to hold? And this all comes back to, understanding the other side of the table and what their objectives are and how you fit that and how you make the case that you fit that. And so at the end of the day, at the end of a business, you've raised one or more rounds of funding, and then you've sold the business. At the end of the day, there's going to be a return to the investor's capital. And that's what, that's what my decision making is all about, is what do I think this return can look like? And so, when you saw the 20% net return, let's just say that across the portfolio, for a company to be a success and to have, a plan that I say, okay, if I invest in this and they execute it, this will be a win for us. It probably has to look something like this for our fund. The bottom numbers is the takeaway. So 73% IRR, 5.3% multiple money. So what that means is if I invest $100 in your seed round, every year that returns $73 to me. Okay, and you need that because if you go back to that prior slide, you need that because this winner, like we talked about, has to make up for all the losers. So when you put together your plan, start to think about, okay, what's the market telling me for a business like mine? What do I have to look like to be a candidate for an exit? How much revenue do I need? Often SaaS companies you hear need $3 to $5 million in revenue to be a real candidate for an exit. Okay, and if I've achieved $5 million in revenue, how much is my company worth at that point in time? Okay, and again, multiples have gone up. It's a nice time to be selling, but 5, 6, 7, 8, 10x on the high end is a really nice multiple of revenue on exit. Okay, so then the next step in your thought process would be, okay, if I need $5 million of revenue, how much capital do I need to generate that kind of revenue? And again, I encourage you to look at market comps on this. Often you see for really successful companies, it takes about $1 of investment capital to generate $1 of annual recurring revenue. Again, this is for a SaaS business. So you put that all together, you say, how fast can I go? That lets you plan out your rounds a little bit. So let's say you need $5 million of total investment capital to generate $5 million of revenue. And at that point, you're a $25 to $50 million company. That lets you plan it out and say, okay, here's my capital plan that you can take to an investor and say realistically, based on market comps, nobody has a crystal ball here, but if we're a high performing company in line with, other high performing successful companies, here's what we could look like over the next 5 years. And that lets you go back to your investor and say, okay, you give me $500,000 today, you hold whatever the number is, 30% of the business, 15% of the business, 5% of the business, you run the math. And it lets you say, okay, if I hit my business plan and you invest $500,000 today and you hold X percent, if I execute, this will be a 70% annual return for you. And I encourage you to sit down with a spreadsheet, start from scratch, do it yourself and project out your cap table over, 2 or 3 rounds of funding. Give yourself some assumptions, some straw man assumptions to work off of and say, okay, I can change different things. I can have my seed investor invest $750,000 instead of $500. How does that change the return? They can hold 20% or 25% or whatever the number is. How does that impact the return and how does that impact my return as a founder? And again, you're not doing these things because it's going to happen, but the levers you can flex here that impact your own return as the founder, your employees' return as equity and option holders, and your investors' return. And so this is a lot of math. I wanted to show the last slide here. I wanted to show you there's some sensitivities here. So pre-money valuation, I think Nick had alluded to this. So say you invest $500K at a $1 million pre-money valuation. That means your investor holds 33% of the business, right? Again, $2 million pre-money for $500K means your investor holds 20% of the business. You can see if you flex the initial valuation on the left-hand side, what that means for the investor's return when you put a model together, and what that means for the cash to the founder. And so you can see sometimes valuation, people get really hung up on it. At the end of the day, if you raise at $1 million pre-money versus a $2 million pre-money, you can see the return implications for your investor and you can see the cash implications for you. And so you got to ask yourself, is it worth, say it takes another 6 months in the market to raise a $2 million versus a 1.5, or whatever your numbers are, what does that really mean to you at the end of the day? And it lets you put, it kind of lets you take some of the heat and emotion out of a negotiation and say, how much do we really, what's a structure that makes sense for everybody, and what do we want to push on and what don't we want to push on? And then the other point you make is on the right-hand side, this time to exit. Time is enormous for your investor. So you see this is flexing only time to exit. And you see a 3 to 7 year range. Your investor multiple doesn't change, right? Everything else is the same, but your internal rate of return changes massively. So when we talk about management and, somebody that's done it before, or maybe been VP of sales at a company previously and, learned and made the mistakes, I can tell you every day I learn an enormous amount. So do our CEOs. Any one of our CEOs, you ask them what they learned the last year, the last month, it's enormous. And, the experience in there translates directly into speed. And that has a huge implication for your investors. So if, you can execute confidently and execute a game plan that can work, it makes your company amazingly more attractive.
Excellent.
So that's what I had prepared. I'd welcome questions or comments.
Yeah. Well, thank you. Joe, one of the contestants, said he just tossed out there as a useful template for cap table game planning, and so that's good. Everybody can use that as a resource.
Yeah, thanks, Joe.
And as you said earlier, what might be a good venture capital backed company? That doesn't mean it's not a good business if you're not venture capital back.
Right.
I mean, and for a lot of the people in this contest, that may be the case. I mean, they may be, it might be a lifestyle business, might be more of a Main Street type business. I mean, it's all about business plan versus, where they wind up. And I don't know any more on that. I mean, where they could, if they don't think they're venture ready, where should they turn for money?
Yeah, it's all about understanding the other side of the table. Like you said, this is I think probably pretty standard for how a lot of venture funds would look at investment, where you're looking for these big returns. Maybe a lot of investors have done well in life, and they want to see jobs in the area. They want to see that kind of thing. So maybe if you're not a company that's going to drive for this big return, look to individuals that maybe have more than just a return focus. Obviously, there's some debt options out there like SBA. I mean, they can be hard for an early stage company. They just can, because of the failure rates. And typically, you need some equity in there to give the investor some upside, just given the risk. But I mean, individuals can be a great spot. WEDC will typically put some debt on top of an equity round. So if you could raise some individual money that lets you get, kind of leverage it a little bit.
Mm-hmm.
I mean, those are some of the main things. It's a lot of individuals though, if you're not looking at venture funds.
Good. A couple of questions here. And by the way, we got a little time because there's nobody behind you except me, and I won't matter that much. We got you.
I don't think that's true.
When you invest, this is a question from Matt. What do you look for in companies that are pre-revenue or have less than 12 months of history building their business? Have you said yes to any of them?
Yes, numerous. That's probably our most common investment has been pre-revenue. So we're looking for companies that have the potential to go big. And so at that point, you don't have sales metrics to go off of. But even when you're 5,000, 10,000 a month, sales metrics can be kind of misleading. So what we're looking for, I mean, again, number one, it's team. Is this a management team, one, that understands the problem they're going after, and two, can execute on it. We're looking for a unique solution in the industry and a solution that's valuable. So, I mean, part of that is market size, right? Is the market big enough? But if, like us, you're looking for a 25 to 50 million, you can do well on a 25 to $50 million exit. You don't necessarily need a multi-billion-dollar market size. What you need, though, is something that is a problem for a customer and they're willing to pay for it. So, like our second investment, Agrograph, maybe example, it was pre-revenue when we invested. It's a software that looks at satellite data to give you information on farm yields. And, it was invented by a professor at UW. So there was some real technology behind it. And then the professor, Mulu Dagan, had gone out and recruited a CEO to run the business, getting Jim O'Brien, who had experience in several startups, had experience in the ag space. And, we looked at this and said, this is a pretty well-balanced team. They know what they're doing. They're going after, a market that we think isn't well served today, that's going to be valuable to its customers. So that got us really excited. That company's really going right now. They were pre-revenue less than 3 years ago. They're now doing $1 million annually. I think they've got some really exciting things going.
Yeah.
So it's all about demonstrating that you can build a valuable business.
Excellent. So I guess don't be afraid for the contestants here to, when your business plan is to a point where you feel pretty good about it, to shoot it to Jonathan, even though you might be pre-revenue.
Yep, please.
A question that came up earlier when we were talking to Chris Haruska from Reinhardt. What about company formation, LLC versus C Corp?
Yeah.
What do you prefer?
C Corp. We invest exclusively in C Corps, and that's very common for venture funds, and I some angels I think have different approaches to that. The reason we do C Corps exclusively is because we don't want the profits and losses flowing through to our LPs. You want it to stop at the company level.
Yeah.
You can convert from an LLC to a C Corp. You can you can operate as an LLC at the beginning and then transition to a C Corp for an investment. Your lawyer and accountant will be very happy if you do that, because there winds up being way more legal and accounting complications than anybody typically wants to acknowledge at the beginning. I learned this the hard way. You talk to an attorney. I don't know what the attorney said, but oh yeah, you just do an election and you flip. But there's usually tax issues. There are complications with that. So if you go out and you want to raise venture capital and that's your objective, really think about starting with a C Corp. Because especially if you have a few years of losses and you got a low basis because you've taken these losses, you can have some issues there, and it can be complicated and expensive to unravel, and it can be a detriment to a first funding.
Yeah, and that's really the answer they got earlier too. That if you think you're going to raise venture, you might as well go C Corp right out of the box.
I think that's right. Yep.
Another question that came up: NDAs. Do you
No, I don't think we've ever signed an NDA during diligence. Very standard for a venture fund. You look at a ton of deals. You could have a conflict in your portfolio. So what that means for you, at the diligence stage where there's no NDA, a venture fund shouldn't really be looking for anything that's confidential.
Right.
If you've got secret sauce in your IP or that kind of thing, a venture fund shouldn't need that to do diligence.
Right.
If there are certain things that you feel like you need a technical diligence for, you can either hire a third party who would be bound by an NDA, something like that. But typically, you shouldn't be divulging anything that is highly sensitive. And honestly, there isn't a ton that is highly sensitive. What's your business plan? What kind of customers are you going to target? Even customer names. I advise our companies when they're going for their next round of funding, just if somebody's serious, just open it up. It's reasonable issues for investors to be asking about. Right.
And I also suggested at the point when it came up earlier, it's, eventually with your portfolio companies, there's a lot of trust, right? Both ways. And a lot of advice. It's more than about the money. It's about the kinds of things you can help them with their business.
Yeah.
And, NDAs are in some ways maybe could be considered a portrayal of a lack of trust and almost out of the box. And so that's probably not a good thing.
Yeah, and the other thing you can do is kind of phase the information. You know, I advise our companies when they're raising their next round to have a non-confidential, very high-level 2-page summary, and then, you know, have a deck that supports your discussion that's probably not super detailed either. And then, you know, underneath that, you can have a data room
Mhm.
that you can go through the initial screen, and, you know, the investor can feel out your investors. Okay, are you really interested? Or, you know, you don't have to go full open kimono right off the bat. You can kind of hold some of this back, and that's completely reasonable too.
Yeah, very good. Other questions for Jonathan? Very good. Yeah, no, it's very much appreciated, Jonathan, for you to spend a little time here today. And
No, I appreciate you having me. I wish you all the best. If, you know, feel free to reach out. I'll share my email in the chat here. If anybody wants to reach out, if I can be helpful, please do so.
yeah, that's great. I mean, and again, yeah, there you go, Jay Horn, ideafundvc.com. Yeah, and again, I encourage, you know, because Jonathan's fund is truly ecumenical. I mean, you're looking at all kinds of sectors.
Yep.
And you're looking at the earlier edge of things too, and you will look at, you know, pre-money. I mean, in terms of revenue. So I'd encourage this group to think about Jonathan. And I think, I mean, you know, Winnebago Seed Fund, Rochelle, I mean, others, right? I mean, kind of most of your network, other than perhaps Rock River Capital, are going to be looking at this earlier phase.
Yep, that's right. Yeah, Winnebago and Idea Fund have basically same investment strategy. Rochelle with the Winnow Fund would go even earlier. I mean, and we've done some of these like kind of 100K formation, kind of co-founding type investments. And then Rock River typically looks at like what would be our second round. So companies that have some revenue, have a product in market, that kind of thing.
Yeah, they're pretty much $1 million and above, right?
Yeah, I've seen them go a little earlier, and but yeah, I mean, I think that's kind of their base case.
Basic, yeah.
Yep. And part of that's just fund size function. You know, we're a $13 million fund. Winnebago's similar. Rock River's a mid-20s million dollar fund, so that means they typically have to do, you know, $1 to $2 million rounds, and, you know, run your return math. It's tough to make that work on a pre-revenue investment. Typically, you see smaller round sizes at that stage.
Yeah. Excellent. Well, thank you, sir.
Thank you. Thanks for having me.
All right. For everyone, bye, and great. We'll see you soon, Jonathan. Thank you.
Thanks all. Good luck. Take care.
All right. Well, everyone, I hope that was helpful. Thoughts or additional questions that you know, popped up in your mind about any of what you've heard, either from Nick or Jonathan or previously Christopher? Yeah.
I just had a couple of quick thoughts around funding.
Great.
That we haven't really talked about yet, and that is the federal government with the SBIRs and STTRs are a great resource for a lot of very early stage companies if you have a technology that fits the portfolio that they're looking for. So just something to keep in mind. And our friends at the Center for Technology Commercialization, the CTC, are great ones to reach out to, that if you have even a rudimentary thought that maybe you could fit in SBIR, reach out to the CTC, and they can definitely help you on that.
Right. That's a great thought, Joe. SBIRs, again, that stands for Small Business Innovation Research Grants. I think it's 11 different federal agencies do make such grants, and you know, from defense to ag to, you know, a bunch of others in between. And so it is really worth thinking about that for many of you who have, I think in particular, tech-heavy kind of plans that may merit that kind of investment. Because federal agencies, they'll do their own research, of course, but they really do look well beyond, because they're looking for ideas that come from the private sector. So well worth investigating as you think through all of your different options. It's not an easy process, you know, I won't pretend that it is at all, but there's a reasonable success rate in getting those those kinds of grants if you have the good advice, like Joe said, the Center for Technology Commercialization, which, by the way, they're mentors in this contest. And so you could find, some of those contacts on our through the website on this. There's a question from Joe. Is there somewhere we'll be able to see a list of the contestants in phase 2? Yes, we're going to get out a news release about that very soon. Kind of who all is in, and I think I'm going to just segue into my closing piece here, because it kind of touches on that and a little bit of what things look like. So, all right, Julie, why don't you go maybe this next slide? So most of you know this piece, but I just wanted to emphasize that it's the Governor's Business Plan Contest has been well subscribed in terms of entries since we started, which was way back in 2004. And we did so at the time because we thought there ought to be outlets for emerging companies that could get involved in terms of being a part of the state, their communities, the whole marketplace, and had a bunch enter over time. I think it's 4,100 or so, maybe even slightly more right now, and more than 300 distinct communities. So there are a lot of towns and cities and villages around the state that have had at least one entry in this contest over time. So next, as you know, because you're in it, I mean, it's a chance to compete for some cash and in-kind prizes, which can include things like legal services that were mentioned earlier. Opportunity to get some feedback on your plans, a way to, hopefully in smaller steps, to move a plan from that, that idea to closer to reality. That's why we start with 250 words and then move to 1,000, then the full business plan. And then at the end, for those who are selected for the diligent dozen, that oral presentation. So next, Julie. Yeah, 18 years, which is hard to believe, but it's really been rewarding and helped add to this overall ecosystem in Wisconsin. That there wasn't much going back at the time, and Joe was part of the formation too. And so it's come a long ways. And so there's the breakdown. A lot of people will look at the breakdown of different categories and say, hey, wait a second, why is life sciences kind of the smallest category? In the end, because life science is also generally the most capital intensive. It's the one that has the longer regulatory path, depending on where it's at, medical device, therapeutics, diagnostics, whatever. It can take a little bit longer. And so even that initial entries into that sector can be a little tougher. Over time, these companies have raised, and basically just angel and venture, the ones that we were able to track in terms of finalists, more than 200 million collectively in fundraising, which is great. And that's really not even counting the grants. And importantly, a high 5-year survival rate. We've surveyed twice all finalists every year in the contest at different intervals, and in both intervals, the survival rate had been 77%. Which, when you think about small businesses in general in the United States and that survival rate, it's maybe half that. So it's a little better, probably a lot better than the average. Next. Some of the folks who have come out of this. Well, you met one of them today in Poco, Nick Masternardi. Vector Surgical, Janet entered the contest 3 times and eventually won it. And she's got customers all over the country and I think around the world now. Matt Howard, his predecessor for Eat Street, which many of you may know, was Badger Bites, Revolution EHR, Biosystem Development, Hyde Sportswear. I mean, a bunch of others that have come through. And by the way, it's not always like the grand prize winner who's the was the big success story out of these contests. Sometimes it's you know, somebody might have been down the list a little bit, but you know, still did well. So next, you know this part because you did it. This is the 250 words. So next, Julie, this is what you're working on now. 1,000-word executive summary, the company overview, product or service description, customer definition. And again here, you just kind of keep in mind, and I think everybody today mentioned it, you know, what's the problem you're trying to solve and how are you going to make money off of that? I mean, that's really boiled down and simplistic, but that's what it does come down to. What, you know, why does the market need what you're doing? And describing the market, of course, the sales strategy, the competition. Again, there's always competition. And the more you know about it, the better off you're going to be. Your team, we talked about that a lot. The financials, about, you know, being realistic and aggressive at the same time, if that makes sense, is striking that balance. And what are your capital needs? And I think it came out today that don't be shy. And Joe, maybe I could ask you to comment on this too. I mean, is it possible to ask for too much capital?
That's a really interesting question. Yes and no, because investors have gotten more sophisticated. So maybe like 20 years ago, everyone was trying to skinny down their numbers and not ask for too much. But I've encountered investors where they look at deals and they're like, you're not asking for enough.
Right.
And so they actually want you to be realistic as to what you really need. So there is definitely an opportunity to ask for too much, but there's also the opportunity to ask for too little.
Sure.
And so I think just getting at sort of an overall theme is don't be shy. What you need is what you need. And as long as you have reasoning around it, people will believe it. So.
Yeah, very good. Okay, next. So for phase 3, and there's a calendar of due dates and things like that coming up here in a minute, but the top 24 or so, you know, roughly half of the folks who are in the second phase, our judges will select them to move on to the next phase. And that's where there's a full business plan. And our definition of full is 15 to 20 pages. And here we're not, you know, specific on how many. I mean, we just kind of want it to fall somewhere in that range. It's the same 8 criteria, and the judges will review them and select 3 finalists in each category to advance to the final presentation round. Now, one thing that, you know, I want to impress on you, if you're selected to be among, you know, those who write the full business plans, yes, it's a lot, you know, it's a fair amount of work. It's already a fair amount of work, right? But at the same time, at that point, there's going to be more exposure, more people are going to be paying attention to you. And for the top 25-ish or so, there's also some eligibility for at least the service prizes, which again, that can be legal help, IT help, accounting help, space, you know, office space, marketing help, a variety of different things. So a lot of good sponsors who really pitch in on this over time. Okay, next. Yeah, the live is the diligent dozen. That's where, you know, there are those presentations. They're pretty short presentations. They're going to be probably around 5 minutes or so. And so if you get to that point, we will have some mentors who spend some time with you to make sure your presentation is really kind of polished up as, you know, on their advice as well as it can be. And so that's, you know, another benefit of this is you get more eyeballs and more feedback. Okay, next one. There's that timeline. So here I mentioned, you know, the day is the boot camp, the 12th, Friday the 12th. So 10 days, that's when you need the 1,000-word piece in. And the judging, after we do some things to scrub that up, the judging begins after that. By the way, Julie has lined up about 80 different judges in all kinds of sectors. and it will remain, in this, all the judges will still be swimming in the same lanes through this round. So they're kind of subject matter experts. And then on down to the practice pitches I mentioned, and Entrepreneurs Conference, June 2021, not 2020, but Entrepreneurs Conference will be coming up. We're gonna be able to kind of focus on things there a little bit. Again, more exposure for you. Okay, next. I mentioned this. Prototyping, that's another category where, there's some in-kind prizes as well. We have talked about the Center for Technology Commercialization. On our website is the Entrepreneurs Toolkit. Also, there's the Start in Wisconsin website, which is also featured on our website, our own Tech Council website, and then SCORE. A lot of mentors out of SCORE who can help with things. So, okay. So Julie has been the focal point for a lot of the communication on this. I think everybody has received multiple emails and will receive multiple more, I'm guessing, before this is all over. So I think I'll stop here, but questions?
I have a question.
Yes.
You mentioned the Badger Fund of Funds and the
Yes.
5 VC. So how they work? Do they work together? Like if we talk to one, you are talking to the 5, or they work independently? Should you pitch to each of them, or so?
Yeah, frankly, it's a little bit of both. Like if you were to send your business plan and make contact with Jonathan Horn, who you just spoke with, he might say, you know what, I'm not really that much into this. Although actually I think he has done ag investments, but he might say, David Trotter up at the Winnebago Fund might want to take a look, or Rochelle Martin at the Winnow Fund. There is that sort of overarching kind of network that makes the Badger Fund of Funds kind of work together. But I think it's always good to try to reach out to all of them. Depending where you're at in terms of raising capital. Rock River Capital is a little bit of the step above for most people in terms of raising. But I think I'd recommend trying to reach out to all 4 of the others if you're going to go down that route. Joe Kramer, any additional thoughts on that?
No, I mean, that sounds good. And I was actually looking at that link that the other Joe sent around, that Milwaukee Tech map. It's kind of interesting. So sorry.
Right. And I'd encourage you to, again, go to our website. There's a pretty extensive, network now of investors in Wisconsin. And let's see here. I think I saw another question pop up. Split in cash and in-kind services to finalists. It's going to be about 50-50. Now, the cash portion is going to be reserved unless, my rich uncle dies and we have much more come into the play between now and then. But the cash portion is pretty much going to be reserved for the top 12, but everybody in that top 25-ish is going to be eligible for something. So that's the basic split. And usually what happens is we're trying to raise, money right to the end. So, yeah, there are now, again, based on, it could be an angel network, angel fund, seed funds, venture capital funds, corporate investors, family offices, about 50 around the state. And so, Joe, maybe we can send out to everybody that map that kind of identifies, where they are.
The players. Sure. That's great.
So good. All right. Well, I will encourage you all to, follow up with questions to me or Julie. Julie can certainly get them over to me, to Joe, who you've now met. Joe at WisconsinTechnologyCouncil.com, and our drill sergeants today, who I really thank for spending so much time with you and answering so many questions and providing some great feedback. So with that, I think we're ready to sign off, and we're only 1 minute late, so that's good. So, all right.
Hey, Tom and team, thank you so much. This has been absolutely wonderful.
Oh, you're so welcome. And
Really more motivating now, to be honest. Right?
Yes. So this is great, and we're looking forward to seeing your next round entries for those who are in that part. And excellent. All right.
Right.
Well,
Thank you so much.
All
Bye-bye.
right. Take care, everyone. Bye-bye. Thank you, Julie, for setting it up.